Welcome to the Deep Dive.
Great to be here.
Today we are analyzing a week in the global markets that felt less like a steady stream of news.
And more like two opposing tidal waves just crashing right into each other.
Exactly. Our mission is to really synthesize that chaos from October 19th to the 25th, 2025. It was a period just defined by this extreme geopolitical pressure on one side.
And then this surprisingly soft domestic outlook on the other. And asset prices that, frankly, just refuse to obey the traditional rules.
Yeah, it was the week where optimism and, I guess, paranoia reached this peak synchronization.
That's a perfect way to put it. On one hand, you had data that was definitive, suggesting the U.S. economy was pulling off that elusive soft landing.
Right, which drove the S&P 500 up 1.2%.
But at the exact same moment, the ultimate anti-crisis asset, gold, was screaming past $4,100 an ounce.
A price that just screams global stability is dead.
It does.
And that paradox, that's the entire story, isn't it? How do you reconcile a market celebrating future Fed rate cuts with a gold rally of, 62.8% year to date?
And then you throw in the ultimate wild card.
President Trump's threat.
Making it crystal clear that 155% tariffs would hit China if a trade deal wasn't inked by November 1st.
That threat alone caused just immediate whiplash. I mean, the NASDAQ dropped 2% in an instant.
It did,
Yeah.
Even with all that other positive domestic news. So what we're looking at is a market that had to decide, which risk was greater, domestic overheating or global confrontation.
And the safe haven snapshot tells you exactly where the fear was pointed. Gold, obviously, at a historic $4,100. And then there's Bitcoin, which sort of consolidated around $108,000. It had a rough month, down 5%, but its stability under that pressure, it really says something.
It highlights its emerging role in institutional flows. We're charting a fundamental divergence here. The U.S. celebrating microdata, while the whole global stage is reacting to this macro geopolitical reality.
Okay, so let's unpack that domestic optimism first. If you just looked at the U.S. headlines, you'd think everything was perfect. What was the specific data point that launched the S&P?
It all came down to a single decimal point in the inflation figures.
The CPI number.
Exactly. The Consumer Price Index for September. It was published at 3.0% year over year. Now, crucially, analysts were positioned for 3.1%.
So just 0.1% lower.
Right. And that difference, while it's small numerically, it was just massive psychologically.
So why did 10 basis points make such a huge difference for the Fed's calculation?
Because it confirmed the trend. It showed that disinflation wasn't stalling and that all those months of high rates were actually working. They were cooling prices without, triggering a recession.
So the market saw that 3.0% and just ran with it.
Instantly. The probability of the Fed cutting rates on October 29th didn't just go up, it shot to 98.9%.
Wow.
That's market certainty. The Fed finally had the data it needed to justify easing up.
And this soft landing argument was backed up by the production side of the economy too, which looks pretty robust. Let's talk about the PMI data.
Absolutely. PMI is so critical because it tells us what businesses are actually doing right now.
And the key number is 50. Anything above that is expansion.
Exactly. The manufacturing PMI surprised a little to the upside, hitting 52.2 against an expectation of 52.0. That shows sustained momentum.
Okay, so manufacturing is strong.
But the real strength was in services PMI. It hit 55.2. That's the second highest reading we've seen all year.
So expanding production, cooling inflation. That is the literal definition of a soft landing. It almost sounds too perfect. Were there any cracks in the employment picture?
There were, but paradoxically, the crack actually helped the rate cut argument.
How so?
Well, job creation was right on target, about 220,000 new jobs, but the unemployment rate ticked up slightly to 4.2%.
So the labor market is loosening up a bit.
Precisely. Just enough slack for the Fed to feel comfortable easing rates without worrying about reigniting wage inflation. It was, for the domestic economy, a true Goldilocks scenario.
And here's where the entire analysis just flips on its head, because that domestic serenity was completely shattered by the noise coming out of Washington.
The 155% tariff ultimatum.
Yeah, let's shift to that. That figure, 155%, it's not a coincidence. It signals a fundamental break.
It's an extreme escalation. To put that in context, the tariffs during the last trade war, they were usually around 25%.
All right.
So this 155% threat, if no deal was reached by November 1st, it sends a clear message. The stakes are no longer just about a trade imbalance. This is about fundamental economic leverage.
And the market reacted violently before it recovered, which tells you the big money, the institutional investors, they took this seriously.
Very seriously. That immediate 2% drop in the NASDAQ, which is so reliant on global supply chains, that showed real anxiety.
But the recovery was quick.
It was, which suggests that deep capital was betting on negotiation, not execution. But across the Pacific, the impact was immediate. The Hang Seng Index fell 1.5% right after the announcement.
So how is China positioned to handle a tariff hike that massive?
They were already dealing with some internal fragility. They reported Q3 GDP growth of 4.8%, which was just a little above the 4.7% expected.
Driven by exports, I'm guessing.
Mostly, yes. But their domestic Achilles heel consumer consumption remained really weak at just 3.0%. They need that export growth, which means a 155% tariff is an existential threat to their current model.
What's fascinating here is just the global contrast. The U.S. is seemingly defying gravity with this soft landing,
While Europe looks like it's sinking.
Yeah.
And that's a crucial differentiator for understanding where global capital is flowing.
Yeah.
The Eurozone is clearly flirting with recession. Their composite PMI was 48.6,
the below 50 contraction.
deep in contraction. And their manufacturing PMI was even worse, down at 45.8.
And despite that, the European Central Bank held rates at 3.5%.
Exactly, which highlights their unique problem. They still have persistent inflation even while the economy is contracting. This divergence U.S. expansion versus Eurozone contraction, it makes the dollar stronger, but it also creates the pressure that fuels our next topic.
The anti-fiat safe havens.
Yep.
Gold at $4,100 is not a fluke. It's a structural statement. This surge, a 62.8% rally this year, it has to be signaling something much deeper than just U.S. inflation fears.
Oh, it is. It's signaling accelerating de-dollarization. When you look at history, a gold rally this severe is usually reserved for moments of profound crisis, either monetary or geopolitical.
It's a vote of no confidence in fiat currencies.
It's widespread skepticism, especially for currencies exposed to sanctions or massive debt like the US dollar. Gold is the ultimate hedge against central banks and currency wars.
Okay, let's turn to Bitcoin, the digital safe haven. It stabilized around $108,000. But given all that chaos, why didn't we see one of those massive speculative spikes like we used to?
Bitcoin's performance this week is really a sign of its maturation.
How so?
We saw a 2.5% gain for the month of October. Now you compare that to the 40% spike it saw in October of 2024. It's a world of difference.
So it's less volatile.
Much less. The analyst Da Vinci Jeremy highlighted that this reflects increasing global institutional adoption.
Yeah.
It's not just a retail speculative asset anymore. It's absorbing these huge institutional flows that tend to stabilize the price.
And that institutional comfort, you can see it in the derivatives volume. You mentioned perpetual futures.
Yes, $1 trillion in monthly volume.
So for the listener, what are perpetual futures and why does $1 trillion in volume prove that stability?
So perpetual futures are derivative contracts that never expire. They let traders take these highly leveraged bets on Bitcoin's future price. When you see monthly volume hit $1 trillion in that specific market, it tells you that sophisticated large-scale financial players are deeply involved.
They're not just buying and holding.
No, they are actively using complex instruments to manage risk and hedge massive exposures. That high volume confirms institutional comfort with Bitcoin as a reliable, tradable asset class.
This combination, gold soaring and Bitcoin maturing, it leads us perfectly to the framework provided by Ray Dalio.
His essay, published on October 23rd, was just incredibly timely.
Oh, was his core argument.
It connects directly back to that tariff threat. He argues that sanctions and trade wars, both historically and right now, they weaken the global monetary order. By forcing countries like China to seek alternatives, sanctions naturally reduce the demand for fiat currencies.
And that makes gold the inevitable winner.
Exactly. So the Trump tariff threat, even if it's never implemented, acts as a global catalyst that just immediately validates Dalio's entire long-term thesis.
It speeds up the de-dollarization clock.
Precisely. And we have concrete evidence. China, in response, actively dumped $51.8 billion in U.S. holdings and continued its aggressive gold buying. This isn't theoretical. This is what central banks do when they prepare for a less dollar-centric world.
Whoa, so for the investor listening, this is where theory meets application. What specific diversification strategy did Dalio recommend for this kind of environment?
His recommendations were pretty specific and, frankly, aggressive for a major institutional voice. He recommended a 15% portfolio allocation to gold
15%.
and a 5% allocation to Bitcoin. For most standard portfolio models, those are massive overweight positions. It signals he sees extreme near-term risk to the current system.
And how are those assets tracking against his own bullish forecast for 2025?
Well, his base forecast for the end of 2025 was quite high. $4,500 for gold and $150,000 for Bitcoin. The current figures, $4,100 gold, $108,000 Bitcoin. They show the directional thesis is correct, but they're lagging his targets a bit.
So in his framework, there's still significant upside.
Driven by that ongoing geopolitical and monetary pressure, yes.
So if we synthesize all of this, the U.S. softness, the 155% threat, the flight to anti-fiat assets, we're left with this bifurcated market that just seems completely unsustainable.
It's a tightrope walk, no question. Domestic easing is supporting stocks. The S&P recovery was led by sectors like tech, up 1.5%, and financials, up 1.8%.
Right.
But that global risk premium is simultaneously pushing gold and crypto higher. The question for every investor is, which narrative is going to break first?
And the sources suggest we don't actually have to guess. Despite the severity of the threat, the analysis points to a remarkably high chance of resolution.
Yes, the underlying consensus, driven by political pressure and just mutual economic dependency, suggests the probability of a U.S.-China agreement is currently sitting at 70%.
The 155% was likely just a negotiating tactic.
Most likely, yes.
And that is our provocative thought for you. If that 70% probability plays out, the market momentum just shifts instantly.
An agreement would remove that geopolitical risk premium overnight. The analysis projects an event like that would lift equities, the S&P 500, by 5% almost immediately.
As all the supply chain fears just evaporate.
Exactly. And conversely, gold would likely push down by about 2% as that safe haven demand softens.
So that potential relief rally, driven by the combination of Fed easing at home and a truce abroad, it fuels this massive bullish expectation we're seeing, a projected S&P 500 target of 7,000 by the fourth quarter of 2025.
A huge target.
And that's what we leave you to ponder. What would it mean for your portfolio if the ultimate soft landing, both domestic and geopolitical, actually happens?